So I don't represent an exploration company. I'm not going to talk about projects. I'm not going to talk about capital raisings or our market cap. I'm going to talk about critical minerals, and particularly in the context of Australia. So for those who are unfamiliar, CRU is a techno-economic advisory firm focusing on metals, minerals and fertilisers, and we're headquartered in London and have been operating for the past 60 odd years. We have two main functions: analysis, which produces regular market outlooks and insights, and we have a consulting group that focuses on bespoke studies, mainly around project feasibility, market assessment, strategy and project financing. So we're all well aware of critical minerals. And so this slide is sort of mainly just a refresher. So critical minerals are defined by those that meet two main criteria. Those that are essential to modern technology, the economy and national security, and those that are exposed to potential supply disruptions. So most major economies have critical minerals lists, including Australia, and we have 31 critical minerals and 5 strategic. So being listed as a critical mineral project can qualify you for a whole range of incentives, and we've heard a few of those today. So certainly, not limited, but some good examples include access to new project financing options, and these include things like the US DOD and the US DOE making direct equity investments in projects. We've got Australia's own Northern Australian Infrastructure Fund with its $500 million critical minerals component. The EU's €2 billion Euro fund dedicated for critical mineral projects globally, and even last night, we have the newly announced US-Australia Critical Mineral Framework. Other incentives include credits. So, we've enshrined a 10% production tax credit for production in Australia here, which is very, very handy. There's discussions around accelerating project approvals, and I'm sure all the miners, explorers, and developers here will be jumping for that. There's also movements around critical mineral stockpiling. So Australia's Critical Mineral Strategic Reserve, which is currently in development, and the EU's new mineral stockpiling strategies. And governments invested in other avenues as well that sort of enable projects, including things like the common user, common user metallurgy facilities and critical mineral infrastructure funds. So supply disruption is often characterised by, firstly, a concentration of mining and processing capacity, and you probably saw a sneak peek of that in the next slide, but also the potential for disruptive events. We've seen restrictions on critical minerals increase in recent years, from export quotas of cobalt from the DRC, controls on or outright bans on exports of various minerals from China. And that has been extended recently into end products around permanent magnets and even in expertise, so controlling their expertise and the leakage of know-how. So industry concentration is a cornerstone of critical minerals. Here we can see China's global market share in mining, smelting and refining for a selection of critical minerals. Over the past few decades, China has built an impressive capacity in critical mineral processing, and this concentration has come about as due to long-term strategic planning, subsidies, and close studies of Western industry. And this has been further bolstered by deep investment in research and logistic chains. And this has resulted, as we've all sort of quite aware of, China dominating the mineral processing sector. And China's now focused on preventing, like I said, that knowledge leakage and maintaining their dominance in this technology, particularly around technology and defence applications. So criticality implies a level of necessity, and this is reflected in mineral demand. So here we show medium-term demand growth expressed in compound annual growth rate, or CAGR, for a selection of pretty much common mineral commodities, including not just critical minerals. And as you can see, the demand for critical minerals is particularly strong, and we look at lithium at just under 15% demand growth annually, and that demand growth is for critical minerals is really focused in those with technology, renewable and energy storage applications. Now, I'm not going to read all this verbatim, but critical mineral development often faces unique challenges, whether it's competing against incumbent mineral processing capacity, particularly in China, the relatively small, niche and opaque markets that these minerals operate in, or the potentially high capital and operating costs. So these factors create uncertainty for projects, resulting in barriers to investment decision making and apply a risk profile that is generally ill-suited to more traditional project financing. And with the announcement of the new US-Australia Critical Minerals Framework, hopefully we'll see some mitigation of some of these risks, but time will tell. So the question is, can Australia be competitive in critical minerals? And where can we be most competitive? So when we compare to our global peers, our mining is generally more cost competitive than our downstream smelting and refining. By way of example, here I've got the lithium hard rock cost curve and the lithium refining cost curve. For those unfamiliar with cost curves, it's essentially cumulative production on the x-axis and costs on the y. As you can see, our mining is broadly competitive, but when it comes to refining, we slide right up on the cost curve, implying a lower competitiveness. And this is probably an extreme example, and I'll get to a few more in just a moment. So anyone following the news will be quite aware that Australia's existing fleet of mineral processing sector is at risk. So we've got high costs, which are certainly a factor, and we'll look at those a bit closer in a few minutes. Also, raw materials from a lot of downstream facilities are supplied on a merchant basis, which means they don't have their own integrated mine supply. And we see several examples of this in Australia. We look at Mount Isa recently closed its integrated copper mines, and we've got other base metal smelters in Townsville, Port Pirie and Hobart, who are all also relying on third-party concentrates for their smelters. And this places them in competition with smelters globally. It's an open market. Market conditions are also another major factor. So, we look at Bell Bay, for example. It had supply disruptions due to the cyclone up at the Groot Eylandt and its ore loader. But its restart is being compounded by low ferronickel market dynamics at the moment, including prices. Obviously, the Indonesian nickel boom has been has led to lots of casualties in Australia, including the Nickel West smelter and refineries. And also our base metal smelters are sort of suffering through a period of low treatment and refining charges. So this means they're operating in pretty awkward economics. And so as a consequence, we see several processors are in negotiation with government for financial assistance, and I think we all know who those are. They're half of those on the map there. So jumping back to cost curves, and as I mentioned, cumulative production X, costs on the Y. We can see a similar trend to what I presented in lithium for our established mineral value chains, aluminium, copper, and steel. So you can generally see that our mining operations are generally globally competitive. And the spread across the cost curve is mainly attributed to local geological factors such as grade, yield recovery, and ore body geometry, and all those sort of funky things. On the other hand, our downstream operations tend to be further up the curve and arguably less competitive in the global context compared to our mining assets. So what drives our diminishing downstream competitiveness? Well, frankly, it's a lack of competitively priced inputs, particularly energy and labour. Here we can see a comparison between Australia, which is in the bright red lines, against our global peers for electricity, natural gas and labour. You can clearly see that Australia is near the top of the pack in each category and generally on par with the EU. And this is not good for a nation that's aspiring to produce and refine critical minerals. And while I'm here, I'll probably just point out that of any lever that the government can pull to improve our competitiveness in downstream mineral processing would be the gas price. Obviously that would lower the gas price, but gas generation is the marginal price setter for electricity prices on all of our energy markets across the nation. So tinkering with one would have a good impact on the other, and no one really wants to lower labour rates. So capital costs are also a driver for Australia's declining downstream competitiveness. Here we can see cost indices for mining, beneficiation and metallurgic plant, and you can clearly see that capital costs in Australia have escalated or risen at a steeper rate compared to our global peers. And we start on a relatively high initial base to start with, so capital inflation is a serious issue. So we sort of covered that in Australia, mining is generally trumps smelting and refining for competitiveness. So I just want to take a closer look at two of our established base metal value chains, copper and zinc. We've done some modelling on costs and revenue across what a typical operator or typical scale of industry in Australia would be, including typical Australian costs and all that sort of stuff. And it clearly demonstrates that in 2024, which is the basis for the modelling, the mining segment captures nearly all of the margin. So, oops. And that's across the value chain. So we're looking at a cumulative margin across the value chain. That's mainly concentrated in the mining sector. So certainly for our base metals, the mining sector is the segment of the value chain which retains the most return. This is also a little bit compounded by the fact that at the moment treatment charges for both copper and zinc are at historic low levels, which is over there. And that's made those operations challenged in an operating context. So, is it all doom and gloom for downstream mineral processing? And the short answer is no, not really. In some commodities, and here I showed just a few, our model costs and revenue across each value chain demonstrates that in 2024, some commodities, the intermediate segment captures most of the margin. And we have some good examples of that. So, for instance, upgrading from, is at the top in the graphite, upgrading from a graphite concentrate to a battery grade spherical or coated spherical anode active material gives a lot of attributed value add compared to the mining segment just producing a concentrate. Similarly, silicon smelter producing metallurgic grade silicon metal offers pretty good value add for a relatively low cost, particularly when compared to further downstream polysilicon refining, which suffers from very high costs, some considerable technical barriers, and probably most worryingly is overcapacity in China, which is resulting in very low prevailing prices. In fact, so low that they're probably around a third of what Australia could produce polysilicon for. Looking at the aluminium value chain, it's a well-established value chain in Australia, and it shows similar margin preference in the production of alumina. So you can see our profits are heavily swung to the alumina sector, and therefore it's no surprise that we export around 80% of our produced alumina. almost run out of time. Okay, so I introduced earlier this medium-term demand growth chart, and now I want to pair that with our export earnings for 2024. The first thing you can see is that critical minerals, the value of those exports pales in comparison to our other mineral exports, particularly the bulks and aluminium and copper and gold. Secondly, you can see that the bulk commodities, particularly iron ore and coal, are among our highest export earners. However, these markets are in stagnation or slight decline maybe, and whilst Australian production might be inured to certain curtailment of these commodities, mainly due to our high quality resources and low mining costs, ultimately we'll need to, in the future, replace some of this export value with, if the nation's hopeful to maintain its current levels of income from mineral resources. And so the task falls to you guys, the explorers, the developers and the miners, to find that replacement value in our critical minerals. The markets you face are relatively uncertain, but our mining sector is strong and is competitive, and real potential exists for us to capture value by moving into those midstream product or those intermediary product sort of captures. So that's those there. So yeah, thank you.